Good afternoon. I'm Rob Murphy, Head of Investment Trusts at Edison Investment Research. Today, I'm delighted to have Michael O'Brien, who's Fund Manager of the Fundsmith Emerging Equities Trust, which, as its name suggests, invests in emerging markets around the world. Welcome, Michael.
Hi, thanks, Rob.
And today, we're particularly going to focus on China because I'm sure many investors are aware, since the cancellation of the Ant Financial IPO, and Ant was about 1/3 owned by Alibaba, there's been a whole slew of various regulatory and other announcements. So we thought it'd be a great time to talk to Fundsmith as fundamental investors in the region about the views on China. So I think it's fair to say, Michael, that you've always been quite wary, and you've warned about the perils of investing in China. Are you actually surprised at what we've seen over the last few months?
I think yes and no. I think no in the sense that we've always felt these risks were present and real. I think probably what has surprised us, particularly maybe over the last few weeks in particular, is the pace at which the regulatory bodies in the PRC seem to be getting stuck in. And I think to us, that sort of is a combination of political determination meeting the needs to micromanage a controlled economy.
Right. And, given this slew of announcements, do you think the worst is over? And when do you think we'll know that the worst is over?
I think as more sectors get hit by the regulator, there's obviously less sectors to be hit going forward, but I think that's probably slightly simplistic in terms of thinking it's over now. I think a lot of the devil is going to be in the detail, and that is obviously going to take a lot of time to come out into the open. If you look at, for example, the Ant case, which I think the Ant IPO was pulled last October, last November, only now are you getting some of the regulatory restrictions brought to the public domain as to actually what Ant can or more likely can't do. So I think it's going to be an ongoing process. I think if you look back, for example, at the gaming industry, the Chinese first started raising concerns about how youngsters were using online gaming 3 to 4 years ago, and we've suddenly had a second round of restrictions coming in there. And I think on top of it, there's other industries which potentially are at risk. I think obviously the Evergrande issue is likely to spur a second round of navel gazing at the property and construction sectors in China. And I think the latest issue you're starting to see reflected in some of the power cuts the country is seeing is potentially what happens when you start getting carbon de-intensification being introduced into the mainstream economy. And further out, and always I think a big risk to people investing in China, you've got the issue of the VIE, or the variable interest entity structure, and of course overseas listings of Chinese companies, particularly I think in the US.
Yeah, so in a way, it's not just the different industries, but how far they go within each industry, which is a bit less clear, I suppose, right? That's something to think about. And then what about the motives behind all of this? I mean, there's a lot of debate on what they're trying to achieve. I mean, what's your take?
I think there's 3 factors at play here, and I think they're sort of coming in together in various degrees of emphasis in terms of the industry and the perceived problem. And I think there's economic factors, I think there's political factors, and I think there's social factors. I think economically, the stability of the financial system is paramount, hence why they went for Ant very early on. I think you have a relatively, particularly in the context of China post Deng and the reforms from the late 70s, you've got a relatively hardline president in terms of ideology. Wealth equalization under the common prosperity agenda is regularly talked about now. They've clearly got a bit of a bee in their bonnet about some of the more outlandish entrepreneurs in the country. And obviously living costs in the PRC are very high. If you look at housing costs, it's got one of the lowest affordability ratios of any country in the world. So I think there's clearly the party wants to be seen to be doing something economically. And I think some of that moves into the political element, which is a second area we think is at play, in the sense that the party is unlikely to, or will find it a lot harder to survive if the Chinese people don't think they're getting richer. I think what the party has to do from a political point is to balance its survival and ideology. You have under Xi Jinping a party which is probably closer to command economy instincts than it has been for several decades. Yet over those decades, China has, in a number of areas, become a free market. And Xi is very interventionist and is likely to get, I would strongly suspect, an additional term in office at some point next year, which I think will have major domestic and regional implications. And I think the third element is social. The Communist Party has its origins very much in trying, in its view, to make China a better place. If you look at how it fought the Civil War, it's very much based on equality, trying to remove some of the more outlandish factors from society. And I think if you look at sort of some of the areas, I think gaming and gambling, particularly gambling, which is almost ingrained in the Chinese culture, does not fit well within a communist country. And I think the other area which they have tackled very hard is education. And we could never really work out why a private education industry, which actually was a relatively large proportion of the Chinese index in terms of the stock market, had actually been allowed to flourish, because it's very odd having private education when you have a Chinese curriculum which is very government controlled, and you even have thought leadership sessions in state schools.
Yeah. And so, I mean, you've maybe touched on one element a bit already on the property side, but aside from the regulatory moves, what else are you concerned about in terms of investing in China?
Well, when we set up the fund, when we launched it 7 years ago, we sort of spent a year looking at companies we could invest in across the globe. And I think when it came to China, there's a number of themes which, if not necessarily common, certainly were occurring far more than they were in other countries. And for example, I would say governance was one of them. The high propensity for fraud to happen at the corporate level. The great example of a couple of years ago is Luckin Coffee, the Chinese version of Starbucks, where it turned out roughly, by all accounts, half the transactions were actually fabricated. I think you have the allocation of capital. Chinese companies typically have a habit of allocating excess capital outside of their core business, which isn't necessary to the benefit of all external shareholders. I think increasingly you have issues of where they put their cash. Quite often, if you look at where we were 5 or 7 years ago, cash on the balance sheet was genuinely cash on the balance sheet. That now is often migrating into wealth management products to chase high returns. There's a large degree of opacity around wealth management products, which again is another thing which concerns us, and they're not necessarily guaranteed for you to get your money back. I think other areas we've seen in China is you increasingly get split voting rights, which is an issue if you're effectively not a founder or management shareholder. And I think from a broader perspective, I think there's two issues which are of increasing concern. First is what happens to the VIE structure. And I think that's particularly prescient in Chinese companies which will list or are listed in the US. And the second element is what happens in terms of political pressure on a number of listed state-owned enterprises. For example, we used to own a business called Travel Sky, which was effectively the global distribution system for airline tickets in China. And for anyone who knows the main Fundsmith fund, we've had similar holdings in equivalent businesses there. And what we found with Travel Sky is first, it was being used as a bank in terms of how the large airlines in China manage their working capital. And I think, and probably more concerning to us, was as the business developed, it suddenly started going into joint ventures with other Chinese state companies. For example, there was a couple of insurance joint ventures, and then a joint venture with a mobile phone company, where clearly to us, its spare cash was being used to bail out, or if not necessarily bail out, help financially support less attractive businesses in the state-owned sector, which may be helpful for the Chinese government, but I can assure you it's not helpful for us as investors.
Yeah, I mean, so that is quite a big list, and I suppose many of those that they're not unknown. So do you think investors have been too willing just to ignore these risks in the past, and do you think that's going to change now, sort of structurally?
I think if you look back at China, clearly a lot of investors have made a lot of money. So yeah, all credit to them from that point of view. But it's not necessarily how we approach investment. And I think where there's been a degree of naivety isn't necessarily in areas like this, but it's more in terms of how the interaction is between private enterprise and government, how the interaction is between you and the companies you own in China. And that typically, if anything goes wrong, you've got to remember that the Chinese judiciary is not independent. I think the conviction rate is somewhere over 99%, which is a remarkable degree of efficiency by any standard. I think on top of that, if you look at the relationship between regulators and corporates in the PRC, it's very one-sided. There's no right of appeal. It's very much prescribed. And I think following on top of that, there is also a very, very big skew to the fact that if you are in dispute with either a Chinese entity or the Chinese government, there will only be one winner, and it's not you. And I think if you look at, so I don't necessarily think people have ignored the core issues. I think it's probably got, and people generally, when I've spoken to investors, other investors have been aware of them. I just think it's probably a case of people happy to put them to one side when the market's been good. And again, as when the tide goes out, you get, it's easy to see who's being caught with probably the least attractive swimwear. And I think one of the examples I would use where to us, it was pretty obvious it was a sector which risked huge regulatory disruption was for Macau Casinos, where a couple of weeks ago, Macau said it was going to review the licenses for the casinos, and it's a 45-day process, of which there would only be one meeting between the casino operators and the government in Macau. And to us, we had one holding in the sector. We sold it several years ago. It was obvious. Everyone knew the licenses were up for renewal at some point next year. Everyone knew there was a big legal issue around the licensors because there's 6 licenses, but only 3 were actually granted on a master license status. You've had China consistently trying to limit flows of cash from the mainland into the Macau casinos. And on top of that, you've got a geopolitical risk where 3 of the 6 casino operators are from the US. And clearly, if China wants to annoy or disrupt US capitalism, it's a very easy shout. When the review was announced, the shares of the main casino operators fell 25-30% on the day. And to us, that was an obvious risk. And was pretty clear that something like that would happen, particularly given the way the risk agenda and the regulatory agenda in China is moving.
Yeah, there's a lot. So, I mean, I guess some people say that China's uninvestable, but you do actually have some exposure. So what are the features of the companies that you own that actually leave you feeling comfortable despite all these risks that you've highlighted?
Okay, we own 6 companies in China, which is about 15% of the fund, and they're across 2 categories. The first one is in fast-moving consumer goods, so effectively they're food or beverage manufacturers. One of the 3 is actually a Hong Kong company which has had a large degree of success building a business in China. And the other 3 are in the technology sector, which, again, not immune from risk, but we think, we understand where the risks are.
Yeah. Okay. And as you alluded, you've got about 15% in China, which is obviously a big underweight position versus the index. But conversely, you've got a much larger overweight exposure to India. So what's behind that, the thinking there?
Well, the first thing I would say about the India exposure, it's not a policy, it's an outcome. And to us, particularly if you think of the FMCG heritage of the fund, India has probably the largest repository in emerging markets of high quality FMCG companies. If you look at it relative to China, and these are all factors which are helping the investability of a lot of the businesses we own in India. India has a much more transparent rule of law. It has much greater protection for property rights. It has much greater protection for things like minority shareholders. And I think if you look at it from a demographic point of view, the China population boom is over. China very much is going to start becoming quite rapidly a declining population. India still has a large runway for population growth, and it also has a significantly lower urbanization rate to China. The urbanization rate for India is roughly half of that for China. So we think, and reflected in the operating performances of the businesses we own, there's several decades of growth there. And I think on top of that, if you look at where India came from, and particularly under the days of the Congress government until economic reforms a couple of decades ago, it was a very difficult country to do business in. You had state borders, you had state customs, which effectively gave anyone who was good and operating there the chance to build a very strong and very sustainable market share.
Yeah. And those are the kind of companies you like, obviously, as you said, the fast-moving consumer goods with very strong, economic moats. I guess you would sort of look at it.
If you look at the portfolio, it's very much geared, or again as an outcome, towards FMCG, healthcare, and what I would call low technology, where these businesses consistently have high returns on capital, the ability to reinvest those returns in growth, high barriers to entry, and typically a degree of resilience and repeatability to its revenue base.
Great. That's been a fascinating discussion, Michael. Obviously, I'm sure we're going to see a lot more news, as you alluded to, coming out of China. Thank you for joining us.
And thank you for your time.